You know, the option prices in the oil market are suggesting that we're going to see $100 a barrel by June of this coming year. Hard to believe because there's too many people that are now bullish saying, oh, it's got to hit $100. Usually the contrarians start to come down and say, you know what, too many people are bullish. Maybe it's going to take a while for it to get up there, but it seems like it's lockstepping its way to $100. The option volatility rarely ever lies. It's suggesting $100 a barrel by June of 2011.
And so why is $100 a barrel important anyway? I know it's a psychological level. Is it an important level for you?
Well, it's a very important level to me, somebody who drives a car, because right now I'm paying about $3.50 a gallon, and that's going to put it up to about $4.50 a gallon, more than I've ever paid. But it's that psychological point where Americans, especially, will start making choices of, do I buy gas or do I pay my mortgage? Do I buy gas or do I go to a ball game? It's that $100 psychological point that consumer confidence seems to shift.
I suppose, sorry, Michael Drage here from Perspective, and I suppose particularly in the US with the much larger cars and that guzzle a little bit more gas than what we do, that can make a big difference. Do you see this as this heads through just also as an opportunity for the GMs of the world who are reinventing themselves to start producing some more efficient cars?
Oh, I think so, and that's happening even as we speak. Even the Detroit Auto Show that's going on right now, there's a lot of alternative energy coming out, alternative hybrid cars. We are far too dependent on oil, and one of the problems is that we're not allowed to even produce our own oil like everybody else is. It's going to cause a massive squeeze, especially if the economy does recover or continue to recover. So it's kind of like a blessing and a curse. We don't want $100 a barrel, but that's also a blessing in a sense that's demonstrating that the economy is moving again and there's greater demand.
It does seem that growth dependent assets, I suppose, equities, commodities, which you're looking at, do seem to be being embraced by investors at the moment, Larry. What do you see as supporting that? I guess the bears will say still joblessness in the United States, housing market's in trouble, Europeans got all sorts of debt problems. What's the reason to be embracing these risk assets?
We're schizophrenic right now. Like last night, it all started with Japan saying, hey, we're going to buy some of this Eurozone debt. And then the Eurozone IP number comes out, and it comes out better than expected. All of a sudden, nobody cares about the periphery countries that are falling apart. The markets rally, and everybody forgets about it. Well, then tomorrow, something else is going to happen. So I think what I'm saying is that the U.S. has like a risk-on, risk-off mentality. And right now, we have a huge appetite for risk. So people are buying equities like they're not going out of style, or they are going out of style. People aren't worried about the bond market or anything like that. People are very bullish on commodities, thinking we're going to have a worldwide expansion. It's just crazy how it all pans out. It's just that the market's very finicky, and tomorrow all that could change.
And so knowing that, what are you doing in this market? How are you trading or protecting your own positions?
Oh, that's easy. I'm 100% alpha right now. I'm scared of the stock market. I mean, it's very, very resilient right now, and it is, climbing a typical wall of worries. But I would prefer to be invested in something that isn't dependent on price going up, price going down. Options and futures related strategies. That's hard sometimes for the common investor just to do that. But we're really rallying a little bit faster than we know how. If the S&Ps right now continue to climb another 10, 15 points, they're suggesting a 5% correction within the next month or so. So I personally am invested in alpha-based strategy.
Can I also ask you, before we have to leave you, Larry, whether you're seeing still an impact from the Australian floods on any particular commodities? Is that registering still on the radar for you?
Well, I hedge my bets. I only trade or invest in commodities that are driven by scarcity and not by technicians, not by economists. It's scarcity. I like platinum, I like copper, I like cattle. It's pretty easy to remember, especially when you have platinum and copper. With world demand going to expand this coming year, it's hard to make a case that either one of those will experience a major correction.